Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. The largest U.S. banks wrapped up their earnings earlier this month, posting significant fourth quarter revenue, profit gains. The U.S. banks reported those earnings thanks in large part to a pretty busy trading season during the U.S. election, sort of pre and post. We're going to dig in today to see what the Canadian banks situation is as it relates to the U.S. banks, but really with the threat of tariffs, the mortgage renewal story, it looming as well. Why does our next guest say that this might be the year of stabilization for the banking sector? Joining us now to unpack the latest in Canadian and U.S. financials, including what's driving performance and how tariffs may well impact the sector through 2025, is Fidelity Equity Research Analyst Thomas Goldthorpe. Welcome. Great to see you again, Thomas.
You too. Thank you.
Let's go sort of directly to a couple of things that were mentioned there. We know in this era of tariff threats that we're sort of sitting in that there are uncertainties. What sort of stabilization can you put towards the mortgage renewal story? Is it enormous? Is it ring-fenced? How should we feel?
Yeah, so it feels like the mortgage renewal story has stabilized. So it's still going to be an impact on consumer spending in 2025, but may not be as devastating as some people expected. The important thing to remember on renewals is you have a 5-year mortgage renewal, your average salary has gone up 25%. You have increased equity in your house that provides a little bit of buffer. And then in general, what we've seen is consumers' willingness to adjust their spending habits to pay for the mortgage. And then, of course, we've seen Bank of Canada rates come down. We've seen the 5-year come down. So they're all benefits. But to be clear, there still is a headwind here. So I think the most recent check is roughly like 0.5% impact on consumer spending for next year, and that will continue into 2026. It looks like, we could have stabilized housing, but it will remain a headwind, but not necessarily a recessionary type headwind to the Canadian economy.
So let's just go a bit further with that. I noticed in some of the notes that you'd written that there's this discussion of it's not like a post-GFC, which was a real blow-up, obviously, in housing, but it did take the U.S., for instance, a decade to deleverage, didn't it? There would be some deleveraging. I mean, that's sort of what we're talking about here. Give us a bit more on that.
Yeah, so there is potential for deleveraging within the Canadian economy, especially with the Canadian consumer, since Canadians added a lot of leverage through COVID, expecting zero interest rates to continue into perpetuity. Now it looks like interest rates will stabilize at a higher rate, so they're going to adjust their debt levels accordingly. And I think when you look at kind of the broader Canadian economy, there are headwinds and there's tailwinds. So clear headwinds are linked to immigration. So at its peak, we had 3.5% type population growth. According to government stats, that could be zero or even negative. You have some headwinds from mortgage resets. You have some headwinds from business investment. So obviously very uncertain time around tariffs and around the political environment. Yep. So a lot of investments being deferred. New condo construction is slowing down. So we're going to see some headwinds from that in 25 and 26. So those are all kind of negative headwinds, but at the same time, we do have lower rates, which will help and help put a floor on the economy, and inflation's low enough that the Bank of Canada can step in if things do deteriorate. And then you also have a strong U.S. economy, which is very rare for it to have a very strong U.S. economy and a recessionary Canadian economy. So the Canadian economy, the U.S. economy will lift up. So it creates again, to the theme of stabilization. So maybe you don't get a boom next year, but you may not get a recession either. So you have somewhere at or maybe even below kind of potential growth rates.
Let's look at the prices for some of these banks and financials broadly. Some will say that a lot has been brought forward. Where does it go from here? I guess there's a little bit of a pricing in discussion there. And also, are they looking through a number of the things that you've just talked about to maybe, past 2026 or at least into 2026? Just talk about the prices ultimately for financials right now.
Yeah, so you think if you just look at the banks in isolation and you exclude TD for its various issues, you're pricing near peak type valuation levels. So that is justified to a degree because it does look like things should be fine, right? Fine through 25, then we should see declining PCLs, whether in the second half of 25 or 2026. And we should see kind of better growth rates as well as we kind of chew through these resets and chew through some of these other things. So I would say we're at a world where valuations are elevated, but they're kind of elevated for a reason. So we're not in some crazy valuation dislocation where valuations are super cheap and everyone's negative, or the opposite extreme as well. It's kind of when you look at the low matrix, they're pricing in better growth, but you also have a reasonable setup, especially beyond 2025.
It sounds like no one's going to have a weekend this weekend because they're going to be watching whether this tariff announcement is going to be really bad, in the middle, really good. We don't really know. That said, what are you hearing from CEOs? You will be in touch with many members of management teams across the financials sector. How are they preparing? Everyone wants to know how the businesses are preparing. So how are they preparing?
Yeah, so I think the thing is, from my perspective, everyone's just going to take it as it comes, right? So it's really hard to plan ahead of this because there's just so much uncertainty. So there's various things they can do. So I know we talked to one of the auto manufacturers, and their view was if this is a permanent thing, they have a lot of plants in the U.S. that export globally, and they have a lot of plants obviously in Canada that exports to the U.S. If permanent tariffs are put in place, you can shift that around to get the Canadian plants to start shipping internationally and the U.S. plants to start selling domestically.
Really interesting. So reversing that, yeah.
But I think the thing on tariffs is there's a very wide range of outcomes. So even the Bank of Canada referred to it is if you just have just straight tariffs, no mitigating factors, that would be extremely negative for the Canadian economy.
Right.
Because it would lead to higher job loss, which would hurt consumer credit. It would lead to weaker corporate performance, which could lead to more bankruptcies and weaker commercial credit. And it could lead to just lack of investment. Since we have these tariffs in place, it's going to be really hard for corporates to want to invest in their business, especially when you add in the political uncertainty. But that's the most dire case. And I think it's important to say there's a lot of mitigating factors as well. So we don't know how long these tariffs are going to be in place. Obviously, if it's going to be in place for 1 month or 4 years, that's very different. We don't know if it's actually going to be placed on 100% of exports. There's a good argument that that number could be much, much, much smaller, like 15 to 20%. There could be mitigating factors from the Canadian government. So the government's already talked about spending fiscal money to compensate people who've lost their jobs over this and lost profits. So the big thing here is it's an uncertain time, highly uncertain. So what you do is you want to stay in front of the news. So we've done a lot of work, talked to a lot of contacts, talked to people who used to be close advisors to the Trump administration.
Like
of
before
the previous
today.
term.
So you've done this, yeah.
Yeah, so we've done a lot of work.
Yeah.
We talked to the companies. We have an impact. We know a lot of the subtleties in the various arguments he's making and what could happen. And the big thing is you wait. There's only so much you can guess. It's highly uncertain. So you just take it on a day-by-day basis, be on top of the news, be quick to react, and then just look what the market gives you, right? So if the market's down 30% on tariffs, that's a very different conversation than if the market's up 10% on tariffs.
Sure.
And then you think of derivative effects as well on stuff like the Canadian dollar. And you boil that down, look at various pockets where you can invest, see what's being priced in some buckets and not in other buckets, and then take advantage of it.
So 2 things on that. One, the example, for instance, of an automaker, auto manufacturer, and maybe doing something very creative and innovative there. What's their lending, like do they want to borrow right now? Do they need to borrow from the banks, for instance, to make that happen? Or, because there does appear to be a lot of either delay or sort of reticence to invest in businesses, you mentioned that. How do you look at the banks through that lens right now? There's a bit of a wait and see approach for those that might want to borrow.
Yeah. So I think the recent trend has been just weaker loan growth, right? So even in the U.S., you've seen it on the commercial side that in fourth quarter loan growth was reasonably weak, and they kind of talked to it that year to date, so in January, they didn't see a pickup, and you may not see a pickup for a quarter or two, and it's going to be more back-end weighted because people want to see more certainty before investing. And I think that theme is amplified in Canada. So if you're going to build a big factory in Canada, it's really hard to do that when you don't know, and especially if you want to export to the U.S., it's really hard to do that with this tariff conversation ongoing.
Yeah.
And it's really hard to do that even with the political change. So
Sure.
it's generally around elections, especially ones that bring in new governments.
Yeah.
There's a reticence to invest. Let's just wait. Let's see what the new guys are going to do. Let's see what the new policies are. And so I think in today's world, if you're a business, you're seeing, let's just delay. Let's just delay for 3 months, see what happens. Let's delay in 6 months, see what happens. And then we could see a pickup once we have more clarity around the tariffs and more clarity around the federal government as well.
A pickup. Do you want to define that? Like explosive pickup? What growth? You talked about stabilization earlier. So could it just even things out for the year, or could it actually be quite material in terms of getting through?
It's probably more incremental at this point, just given where Canada stands on competitive position versus kind of other countries and various other things. But at the same time, it is, you could see incremental positive pickup.
Okay. Through the different financials, it's been a very interesting time. They have had idiosyncratic reasons why they haven't traded as a pack in the way they often have, within a range, but a fairly tight range. That has changed. Is that still the case? And is there still room, perhaps based on the tariff story or other stories, to invest because there are real opportunities and dispersions within the group?
Yeah. So to that conversation, 2024, we had the widest dispersion.
It was wild.
Between the banks, and the type of dispersion you normally see in years like 2009 or 2008 when things are really volatile. You actually had 10-year wides. You look at kind of best versus worst, top three versus bottom three. So you had a lot of dispersion. And it feels like in this environment that dispersion is going to continue because the banks are on various dispersion paths, right? So you have a new CEO at TD, you have Canadian Western Bank being acquired by National, you have ongoing restructuring of the Latin American business or repositioning of the American business through Scotia. So you have a lot of different themes. You have, do I want to own U.S. versus Canada due to tariffs or not? You have FX considerations. So there's still a lot of variability and uncertainty in the world, and that variability and uncertainty allows for kind of stock picking and promotes more dispersion within the group, which is, as a stock picker, it's what we love at Fidelity, right?
Right, okay, super interesting. And you expect that to carry on. It's been a trend, but you expect it to carry on. Let's look at some of the other businesses within what you cover. I mean, sort of the wealth management story. Also, the investment banking story is very interesting. We're expecting tons of deals, we think. There's sort of exits that are predicted and expected, but there hasn't been a ton on that right now, probably because of all the uncertainties. Give us a bit of a landscape of the capital markets going forward, the investment bank businesses.
Yeah. So in the capital markets in the U.S. is a strong thematic that with Trump coming in, with less regulation, and some maturity of fund issues, you're going to see a pickup in investment activity just on greater confidence, right? With that, with fourth quarter earnings, with the U.S. banks, they talk to kind of full pipelines and potentially seeing a pickup in activity. The one caveat is we haven't actually seen that yet, I guess, year to date.
Well, we haven't.
As much.
Yeah, and you can see maybe why, but is that just is it just a short-term timing thing?
Yeah, it's probably short-term because it's probably short-term, just because you want to see more certainty. So what we've heard from commercial clients is in the U.S. is they just want to see how this Trump policies land out, right? And also, I guess there's a bit of rate side as well. There's an expectation that rates are going to come down a lot. Now rates have stabilized. So there's still a bit of back and forth negotiation to come, but the expectation is we should see a pickup in the U.S. and then some of that pickup in the U.S. should benefit Canada as well. So in Canada, certain banks have strong U.S. capital markets businesses that should directly benefit. And then Canada, if U.S. capital markets activity is strong, generally Canada benefits from that as well. So we may not get the same order of magnitude of benefit, but we should see a benefit as well in Canada from that activity.
What is the conversation, if there is any sort of a live conversation, of deregulation in this country? There could be a government change. If there was, would deregulation follow? Probably it'd be more muted than the Trump deregulation trade and discussion, but what is the discussion here in this country?
Right, so in terms of regulation, I think if the Conservative government gets in, there's still kind of uncertainty around whether he's going to be a friend of the bank or not a friend of the bank, since in the past he has had some negative rhetoric towards the bank, but it's unclear once he gets into power whether that's going to be enforced or not. But I think the broader theme, though, is over the last 10 years, we've seen tighter capital rules and tighter regulatory rules on the Canadian banks, and we could be entering a period where, at a minimum, things don't get any tighter. Okay. So instead of progressively tighter every year, maybe we have some stabilization. And then there is a scenario, maybe not the base case scenario, that we could actually see a loosening of some of the Basel III rules, just given that Canada was first to adapt those rules, where there's an expectation that U.S. and Europe would follow. Now it doesn't look like U.S. or Europe will follow, so you can reset back to those previous levels. And there are some excess buffer being built into the capital to deal with economic uncertainties. That maybe as the economic uncertainties decline in the coming years, that some of that could be pulled back as well.
So what's that worth to some stock prices? Like what could the deregulation, also what's being built in is sort of the uncertainty buffer, as you say, like you're going to be looking further out past some of that stuff. What could it be worth potentially? Right.
So the idea is you would expect, if you hold less capital, it's higher, it would promote higher ROEs, which generally promote higher price to book ratios and promotes kind of multiple expansion. So, because ultimately what the capital ratios are is every loan you make, you have to hold a certain amount of capital against that loan. So if you have to hold less capital against that loan, then it increases returns. And for a given level of growth, it ultimately increases your free cash flow generation, means you can return more via dividends and buybacks. So it should be a positive trend over time if we do get more favorable regulatory environment.
Okay, that's really interesting how all of that works. So things, in theory, should get better after some short-term uncertainty, we hope, for sort of the overall picture. Do you want to spread out a little bit to some of the other financials that you cover the banks, and actually your colleague does more on the insurance side of things, but there are others in there. Do you want to comment on sort of the prospects?
Yeah. So I cover kind of diversified financials. Yeah. So there's the asset managers and some of the specialty lenders, right? And I think the big thing there is there's a lot of unique idiosyncratic stories which you could drive alpha through picking. It's more of a stock picking group, and there's always this pull and take, give and take between, do I own the banks, or do I own financials, or do I talk to Connor, who's an insurance analyst, and do we own insurance, right? And there's always
sometimes
a lot of
one is offsets the other depending on the cycle. Yeah.
Exactly, right? Yeah. Or there's fund flow, or there's other kind of non-financial reasons why there's a dislocation between the two groups, and then we can kind of step in and take advantage of that. So within the diversified financials, there are some exciting ideas. Like there's alternative asset managers, which have a nice long-term secular tailwind, as the alternative asset managers take market share from more traditional asset holders like the banks and the insurance companies. So there's some opportunity there. There's some opportunity in the alternative lenders that can take advantage of stuff like the Alt-A mortgage market, or like the subprime mortgage market, which especially in Canada, they're a more niche market that isn't necessarily fully understood, in that there are different risks and rewards in those markets in Canada versus the U.S. And the big thing here is it also just gives us more ability, right? So some of these companies are 100% US dollar exposed. So you want to play a currency angle, there's a way to play currency there. So there's a lot of different views that can be expressed. And I think that's, again, a big part of our job is get your earnings right. That's obviously first and foremost. And part of getting your earnings right is understanding various themes and trends, and understanding how those themes and trends in a ever volatile world impacts individual securities, and then picking those securities and making sure you invest with conviction in those securities that benefit the most from that.
I'm so glad you brought up currency. Let's go there. Okay, so the Canadian dollar has had the trajectory that's probably expected. We heard Bank of Canada Governor Tim Macklin addressing it, but also talking about, as much as it has to do with interest rates, and it does, and there's a big differential at this point, a widening gap between the US currency and ours. But there's also obviously the tariff story. There's a lot of other domestic issues that go into that. Your outlook for the Canadian dollar right now, does it just sit sort of where it is? It's dropped below sort of 73, 74? Do we just sit at this lower level for a while, or is there an opportunity for it to pop or at least come up a bit?
Yeah, I guess it's, again, to the theme of uncertainty, there is a lot of uncertainty in the Canadian
you were
dollar.
Going to say that, yeah.
But on saying that, I think there is still potential for pressures, whether it's like tariffs, whether it's a widening gap between interest differentials and growth differentials between the Canadian and the U.S. economy. So in times like this, you have to be careful because it has moved a lot. You don't want to necessarily
That's interesting.
press. But at the same time, you have to be conscious of there is kind of real pressure on the C dollar. And the other thing the Canadian dollar is, part of it is it's weak versus the US dollar, but a big part of it too is the US dollar is strong against all currencies.
Exactly. So how do we look to other stories, across the globe, potential trade opportunities, other places from a currency angle?
Right. So it looks like from now, for at least for the time being, does look like US has differentiated growth and interest rates versus the rest of the world. So there's not a clear reason why we should see kind of material strength in the Canadian dollar at this point.
Okay. If you're an international investor with money to put to work, maybe not in the US, but something that's exposed and so on, how much of a put off is the level of the Canadian dollar right now?
Yeah, so I think
foreign direct investment right now.
Yeah, so I think for a non-US investor, everyone's feeling the same currency pressure, right?
So keep it at home, maybe.
Yeah, or and ultimately, I think with all this macro stuff, you don't want to get too cute around currency and really just focus on companies, right? Because one of the worst mistakes you can make in investing is not buying the best idea, the best company, because you're worried about FX, right? Because generally the benefits of picking the right companies and getting your stock calls right is going to overpower a couple percentage here or there on the FX.
Okay. No, really, really fascinating. On that, what do you think in terms of the U.S. banks, which we sort of basically gave them a bit of an A grade, their prospects going forward, because they do have a deregulation story that they are closer to clarity on, let's say. I mean, they have some clear paths where things are going to roll back, Basel III being one of them. What are the prospects there?
Yeah, so I think it's the U.S. banks are still relatively well positioned, right? So you should see an acceleration in loan growth, maybe not immediately, but over time. There's a clear path to improved capital markets activity.
Right.
There's a clear deregulation agenda in the U.S., not just from a financial regulatory standpoint, but also across the economy. So, and a lot of this stuff is it just creates business confidence, right? So it creates the confidence for businesses to want to invest in the country, right? And there's this optimism, this increased confidence, which should drive positive performance. And yeah, so it feels like they're still relatively well positioned to do well, just given the current market setup.
And I mean, within sort of the broadening trade discussion, which is, again, a back on, and also efforts to diversify within the equity markets, within the North American equity markets, where do Canadian banks versus US banks, I mean, they're ballast corporations, they act sometimes almost like a bond proxy, but is it part of this broadening out, and will you see flows ultimately? Where does it fit in that narrative?
I think it's kind of in between. So I think part of that broadening narrative we saw in the second half of last year, right? So in the second half, we saw significant multiple expansion in both the Canadian and U.S. financials on forward numbers actually not adjusting much. So most of that move was multiple expansion. Most of that was from a broadening theme. I think in both cases, especially in the Canadian case though, there was a view that 12 months ago that there was significant housing risk in the Canadian economy, significant recessionary risk, and this view that interest rates would stay high forever because inflation was out of control and they just had to stay high. And I think that scenario has been de-risked out of the market. So that's kind of the world we're in now, I think, is it's not necessarily the forward I think they're going to make, or the market thinks they're going to make way more money in their base case scenario, but you have de-risked the bear case scenario, and by eliminating the bear case scenario, it does create a better risk reward setup for the stocks.
When you're talking to how companies are preparing for tariffs, are taking a look at what they can't do, and so on, what is the general line on exports being brought forward before the tariff announcement, which might be tomorrow? We don't know. We think maybe. Has that been a discussion point when you've spoken to various firms that they've noticed that the export numbers have tried to get ahead of this a little bit?
Yeah. No, there's definitely evidence of it.
Yeah.
It's always a tricky time of season because it's it's very close to Christmas, right?
Yes.
So sometimes
There's
it's
action
hard.
anyway. Yeah.
Yeah, like it's hard to tell and things are already full and stuff. But I think what I've heard is from like the more commoditized the product, the more willing to pull up, right? So yeah, you fill up your tank. If it's steel product, I'm going to bring in some steel, bring in some aluminum, stuff like that. So I wouldn't say it was like a massive pipe fill, but there was definitely some pull forward. Especially because there's very little risk, and especially the most commoditized products of just pulling that forward and making sure that you don't have to pay tariff on it.
Again, you just sort of wonder the impact on the economy, like if they brought that forward, what it means. But I guess it'll depend on what the tariffs look like. So
exactly right,
yeah.
And we'll see, right? We'll see, right? There's a lot of uncertainty, but also I think that's, as I've been harking on, I think the uncertainty is kind of where we perform best, right?
Okay.
Because that's the time when you get big dislocations, you have irrational selling, you have panic selling, and you have really big differentials, right? So again, going back to that COVID example, I think during COVID, you had extreme dislocations between very similar stocks, the extreme fear in the market, the extreme narrative. You had a lot of people just selling on emotion, not selling based on fundamentals, or people selling on imperfect information, right, where we had probably better information than a lot of other people, given our global network, given our team, given our diversified team, presents opportunities, right? Okay. So theoretically,
tariffs present opportunities for you, and that is, maybe we'll leave it there. Is there anything else to add to that? Because that just seems you'll be going fishing.
Yeah, no, I think it's the same, right? So with the banks, you have diversified financials. There's a lot of room to stock pick there, and a lot of room to express differentiated views with conviction, right? And I think that's the key to obviously active money management is you're able to bet with conviction, able to be right more than you're wrong, right? So, and I think as a team we've done well, and I think if you look over time, we do best with the most volatility, right?
Right.
And where we can where our franchise can really shine through.
Thomas Goldthorpe, a delight to see you. Thank you for joining us, and have a good weekend. Enjoy watching the tariff rollout discussion.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.